I'm Ken Whiting. I'm from the law firm of Glazer Weil in San Francisco. And the second panel today is about retail. None of us can walk into our neighboring mall and not notice that there's a different tenant mix than there was even 5 years ago, or our local strip mall or our downtown area. And retail is changing very quickly, and the gentlemen who are with us today on our panel are going to talk about that topic. And specifically, they're going to talk about the trends that are changing the retail experience and how those trends are going to change values in the retail sector over the next couple of years. They'll tell you more about their backgrounds as they address these issues, and their bios are obviously available in our materials. Very briefly, I'd like to introduce them. The first is Bruce Christy, who's a jack of all trades here and our moderator. He's with Cadence Asset Management and United Growth Development. To his right, we have Michael Schurer, who's the now retired CFO of THOR Equities, lucky guy. Joel Tomlinson is the Senior Vice President of Acquisitions at Realty Income, which is a Fortune 500 company, I believe, dedicated to getting high dividends and high income to its shareholders. And finally, Jonathan Lischke is the managing director at Merlone Geier. Is a managing director at Merlone Geier. He's in charge of acquisitions, and Merlone Geier is a private REIT which focuses on the redevelopment of retail and mixed-use properties in the western United States. And with that, I'll turn it over to Bruce.
You can. And good afternoon, everybody. Retail got growth? Well, this is a question that comes up from time to time in coffee meetings, lunch meetings, and in conference rooms. And what we see with retail is that over the last 7 years, it's had phenomenal growth. And right now, keep talking about how there's a lot of turbulence in the market and some challenges ahead. So today, we're going to introduce your panel. And the panelists all have different backgrounds that really blend well together for today's conversation. And we're going to talk about the state of the retail market today, kind of put us all in the same area. Then we'll talk quickly about what are these major changes that are influencing our retail portfolios. And Ken just got done talking about a lot of the key ones, so it's a nice blending of all that. But overall, this retail got growth, trying to focus on how's it going to impact retail portfolios. And these three gentlemen are so great to have here because they're very active in what they do, and they all come from a slightly different perspective of the marketplace. We have Joel Tomlinson, who's in the middle, and he comes, if you look at the black area up there, net leased retail, and they invest across the country. So he has access to a whole bunch of different tenants. He has access to a whole bunch of different market information. Michael Schurer, he comes from another area, which is called urban high street. Mixed use, high-end luxury retail, high-end luxury residential. It's another sector of the retail economy, and US and globally focused as well. And then Jonathan Lischke, he comes from yet another sector, which is the community shopping center area, and also you can layer in there grocery anchored centers. And they invest in the western region in the US. So you take that profile of what their portfolios look like and the activity that they do, and it's going to help out the conversation. So now let's get started by setting the context for today's conversation. In your package, you have a bunch of slides. We're not going to go over all the slides. They're there for your reading pleasure. We're going to go over a few of them, though, just to set the context and help us all get together. We're going to look at some business cycles, property cycles, and capital cycles. On the business cycle or the economy, it's had a good run for 7 years. And right now, we think it's in the mature phase of its cycle. We're looking at job growth. Also, it's been robust for 7 years. The January jobs report shows maybe a slight moderation starting to happen. Ken talked about that a little bit. Retailers as a group have been performing very well. If you look at a broad-based index of discretionary retailers or necessity-based retailers, over the last 3 years, they've performed strong, about 12% and 9% per annum for each of those groups respectively. And then growth, what do we think is going to happen? We think 2017 GDP is going to outperform 2016, which kind of helps. So a little bit of a mixed message in there, but doing well. The property cycle, or your physical assets, there's been a lot of momentum that we've experienced, but we foresee a slowing in rent growth, and that's one of the key drivers of the momentum. What we see is that retail, the life cycle of retail, going from a trough to a peak, we've been going up that climb, and now we're nearing a peak. And with that, rents had been increasing and vacancies had been decreasing. Well, right now, we're starting to see some rent growth slowing. It's moderating. If we look at over the last 5 years, rent growth year over year was increasing 8% to 9.5% per year. It grew in 2016, but at a more modest pace. We look at construction and new space being delivered to the markets. That continues, and it's on an upward swing. It's being delivered mostly to the major metropolitan areas. When we look at headline news we all read about of another retailer closing, well, that's pretty dramatic. What does it mean? Well, 2016, there was 4,000 major retail chain closures and 26 major retail bankruptcies. That's a lot of excess space coming back into the market, also increasing vacancy, putting downward pressure on rents. So with that, what do we do? Well, we look at the capital markets, and the capital markets have been very favorable, and they're starting to incur some headwinds. What we see is transaction volume. Transaction volume has been incredibly strong from over the last 5 years. Just year over year, just continues to grow. 2016 was also strong transaction volume, but 16% off of 2015. That's kind of interesting. Then if we look at the cap rates, or the capitalization rates, equates to the pricing of these assets. And when we look at that, we're near 2007 levels. That should make us stop and take pause for a moment. But when we look at that, one of the things that we notice is there's these sub-property types, which these gentlemen represent, and there's a widening disparity on the pricing of those property types. I have to ask why. That didn't happen 10 years ago. Wasn't as prevalent 5 years ago. One of the things that we notice is that when the Fed increased rates, what happened in the marketplace? Well, borrowers went to go take out loans, and if you were in big retail, high-quality retail, you didn't really feel the pinch too much. The lenders took up a lot of that Fed increase in their rates, didn't really see too much change, and thus the values stayed about where they were. In the smaller assets, they weren't quite as nice. They passed through some of that change, or a lot of the change, quite frankly. And what we would see is we would see the pricing of those assets change about 20 basis points on average on the smaller cap retail. Now, mitigating all of what I just said in the capital cycle, there's a lot of U.S. money and international money flowing to commercial real estate. It has been, continues to be that way. There's policy changes that are impacting that. And one of the main reasons is that it's a very strong leverage yield. You get security of collateral, and you can do a portfolio hedge with it if you're planning large portfolios. So with that, with the state of the market being a mature business cycle, property cycle probably nearing its peak, and the capital cycle incurring some headwinds, what do we do the next 2 years with our portfolios? Well, there's dominant sources of change that we look at, and we've got cyclical patterns, secular trends, and structural shifts. I just got done talking about the cyclical patterns. Ken spoke really well about the structural shifts. And then there's these secular trends. The cyclical patterns and secular trends tend to go together, and they really impact the short term. The structural shifts tend to impact, 5 years and longer, generally, what we see. Some things we mean by secular trends: demographics, age shifts, wages, housing affordability. In the urbanization area, our first panel talked a lot about that. Densification, walkability. We've got technology is impacting and enhancing experiential retail. It's also providing the sharing economy, which is changing what's happening in retail and changing what's happening with the physical assets, energy in the environment, and the others. So with this, we look at real estate. It's hard to measure the risk today. Risks vary by asset and very hard to predict. So when we are looking forward, what assets should we focus on? Because it's not impacting each subtype of retail the same way. And some of them, grocery anchored centers, for example, are insulated by a lot of these. Malls, maybe not so much. So there, we briefly set the context for the panel, and I think it would be a great time to go involve our esteemed panel and see what they've got to say. Joel, do you think we're going to see growth in our retail portfolios?
Okay, so we're all different here from different backgrounds and do slightly have different goals in our investing strategies, but we at Realty Income are buyers of income streams. So we're passive income investors. We're buying income producing assets long-term to pay a monthly dividend to our shareholders and increase that dividend over time. So we all, probably the three of us here at least, look at the world similar in some fronts, but also a little different with how we look to invest and what we look to invest in. In terms of 2017 and just growth and property transactions, Bruce and I were talking earlier, and some of you in here might have seen, there was an article in the Wall Street Journal yesterday about property transactions being down. I think last year, 2016, was off $58 billion lower in transaction volume than it was in 2015. And we are seeing, I think coming into this year, we've averaged probably around $1.5 billion in new property acquisitions each of the last 5 years. And I certainly am seeing, at least in our world, a little bit of a slowing in the pipeline. Volumes coming down a little bit. It's a much more cautious institutional environment right now. And some of that is driven, I think that the rate increases, the market anticipates a couple more quarter-point rate hikes probably this year. I think that's priced into REIT stocks already, such as ourselves. But there's other variables too at play. The non-traded REIT sector, I don't know if you guys are familiar with that or not, but that was hundreds and hundreds of millions of dollars were being raised in 2012 and 13 and 14. And there was just a ton of money out there chasing deals and not enough deals. That's no longer the case today. I think that today's money is a little bit more cautious in terms of what they're buying and how they're buying. But all of that sort of contributes to what I think is going to be a little bit of a slower 2017 as far as overall transaction volume is concerned.
That's good to know, and I know you guys are across the U.S., I think around 4,700 properties in your portfolio.
Yep.
And that's a lot of exposure to tenants besides. Jonathan, what about you for the vantage point that you guys are in at Merlone Geier and being involved with community shopping centers, smaller malls, and grocery-anchored centers as well? Just from that standpoint, not your company maybe specifically, but for the industry, do you think there's growth in 2017 in that sector?
You know, it's interesting, 'cause especially in the grocery anchored space, which tends to be, because it's a necessity, it tends to be a little bit insulated from e-commerce, that there's still a tremendous amount of interest in grocery anchored, neighborhood centers, or community centers. And I think, the other thing that's interesting is when you look at the effect of e-commerce on those transactions, right? The mentality of the consumer is that, we want our deliveries and access to goods, faster and faster. And you think about, 10 years ago, people would be excited if their book from Amazon or product showed up in a week, and then it became 2 days, and then it became 1 day, and now it's same-day delivery. And now with Amazon Prime and Fresh and Prime Now, you're talking about 30 minutes to 90 minutes. And where that comes into play with grocery anchored is that as populations increase and you have more density, right? You need to have locations that are close into population centers in order for that serve effectively as distribution channels, both on the grocery side and then also on the shop side.
Is that going to change around the physical design of a grocery store, format, size, or the location?
I don't see that. I don't see that happening yet. I mean, I think that right now, for example, when you go into Whole Foods, or you'll see Instacart shoppers around, right? They'll be so we haven't yet seen. You're seeing some groceries look to do some defensive positioning by maybe reducing size to try to fill in areas to protect turf. We haven't seen yet a significant effect in terms of changing location or format.
I got you. Joel, with your portfolio, do you guys locate near grocery stores at all? Or do you like to find assets? Because I know you don't buy those assets, but do you try to buy assets that are near them because that helps your growth?
Not necessarily, no. And I mean, a couple of things. One, I think that today's world, in terms of real estate investing in general, is very exciting, and we're at a huge transition right now. And the way that we've all looked at real estate investing in the past is not the way to look at it going forward in the future, given e-commerce and just how it's changing our world. It's changing retail. Look at Macy's, JCPenney's, Sears, Sports Authority. That was more of a leverage situation, but there's a lot of retail that's just getting hammered right now and struggling because of the changing e-commerce world. But to answer your question, do we look at proximity to grocery? Not necessarily. We're looking at necessity-based, low price point retail that e-commerce is not going to impact, or the impact will be minimal. We love QSR restaurants. I mean, a lot of people are on the go now. They're doing everything on their iPhones. A lot of single parents that QSR restaurants do pretty well in good times and in bad. Same with gas stations, and we could get into a whole side discussion on gas stations and the future of fuel, and are all cars going to be electric? But what is a company like 7-Eleven, for example, is doing a phenomenal job of is, regardless of fuel, they're focusing a lot right now on their inside store sales, their product offerings, doing a lot of private label offerings where their margins are better. But they're taking a lot of business away from QSR, which I just mentioned again, because so many people, you think of C-stores historically and you think hot dogs, candy bars, pretty much disgusting stuff. That's not the case anymore. A lot of these C-stores are realizing they're trying to do fresh deli service product offerings. They're having industrial facilities that are making fresh served product daily delivered to C-stores. And I mention all of this now just to say that I think we're at the forefront of another evolution, even on that landscape, where because of this iPhone fast now mentality, people are not going out like they used to just sit down, kill an hour and a half at lunch. Everything is kind of on the go, and time is money. So, but that's a long answer sorry. Just we look at, again, low price points, necessity-based retail, and we're very mindful. And even we own a lot of industrial assets too. So as logistics and infrastructure change, we're definitely keeping a close eye on Amazon. Amazon's attracting a lot of capital from abroad. A lot of money is coming into the United States now, pursuing industrial that historically was never the case. So
I got you. So both of you talked about the necessity side of retail. This is a great contrast to the world that Michael's lived in for a lot of years, where he's been able to be part of luxury. So if you look at back to that primary question of 2017, do you think there'll be growth in that sector?
Luxury wants to be in certain places, certain blocks within any given city, and to the extent they've achieved that agenda, those cities are sort of exhausted for that opportunity, and so it means reaching into new cities and broader cities. THOR, basically had a number of assets on Fifth Avenue in New York. We had assets on Madison Avenue in New York, and when we placed a Brioni or something of that high magnitude, or a Valentino at our asset at 693 Fifth, we basically were done our leasing agenda on those particular streets with the assets that we held. So then we move on to new markets. 760 Market Street in San Francisco is a great asset for us. We did the retail lease up. We completely redid the whole office component, where it was all single tenant office. This is the size of a hotel room, and now it was single floor, high tech tenancy basically, and did really well in the exit of that building, and learned through that about the demand in the tech industry specifically for certain types of space. So now what THOR's doing is exploiting that learning, and we're buying more and more properties now with that knowledge outside of the specific luxury segment. In Europe, we're still doing very much a luxury element. We're on Bond Street and New Bond Street and on the Champs-Élysées in Paris. So we're in those kinds of markets for the luxury demand that still exists, because there is periodic turnover. The rent structures over there are so unique that it's really hard to move rents. It's very tenant-friendly over there. So it really becomes a merchandising strategy more than anything else. So as vacancy occurs, there's usually demand to get a presence in a market that doesn't turn over very frequently.
Do you think
so
in the
that's
luxury,
working.
I'm sorry. Do you think in the luxury area that you play in, you mentioned how the major markets, a lot of people have already gone there. do people in the U.S. need to go international to get the growth that they want in the luxury sector?
The U.S. brands going abroad?
Yeah.
Yeah, we're definitely seeing U.S. brands that need that for the same reason international retailers came to America, because their brand isn't familiar and they had to create awareness, so they do it on these high streets. Inversely, the American companies have to create that same awareness, and they'll find certain markets in Europe where they can do that. It's usually cost prohibitive for them to be in certain markets, but there's a Nike store on Champs-Élysées, and our building is 65. So it's definitely an American presence there and a growing presence.
Gotcha. So what I kind of heard is necessity-based, there has been growth, there will continue to be growth, and e-commerce isn't taking away too much of that. On the luxury goods, maybe e-commerce is helping it, but going to have to expand geographically.
People want to touch these luxury things, and a lot of these retailers use their stores for marketing. The Valentino store has one of any given item, and the rents they're paying $3,200 a foot are just astronomical. So they're doing it for marketing exposure, not necessarily to sell product.
If we go back to some of these broad changes, so we talked about where are we in the markets today? We got some turbulence ahead and not knowing exactly where we're going to be in 2 years. So if we look at these dominant sources of change, are there any that, there's no right answer because things are moving so quickly, but are there any of them that you think are influencing your portfolio or your sector of the industry, let's say, more than another? You know, there's a concept, maybe even in priority, the global economy. There's debt capital, demographics, urbanization, domestic policies, and then the one that we all keep hearing about in our boardrooms, experiential retail. And what does that really mean? But let's not do that one right now. But those ones, you know, global economy, debt, demos, urbanization. Is anything kind of really driving your business more than something else? And I'll leave it with this. On urbanization, there's this concept of urban amenities being brought to the suburbs. It's just one small example. Shifting populations. So what do you guys kind of focus on? Jonathan.
Yeah, I would say what's interesting, it's a disruptor in the bit of a disruptor in the grocery space is demographics, and I think that what you're seeing is a couple things. One is that ethnic markets now, I think, are much more accepted by institutional investors, and it's really less of a focus on, for example, traditional credit, and it's more a focus on the micro as to how are these markets performing, what are their sales, and you've started to see this too in valuations, where, for example, for ethnic markets, the cap rate spread has started to narrow between where they would trade and where a traditional credit anchored center might trade.
Can you explain that just for a second? I know we all get that, this concept of credit. So you have a retailer.
Right. So for example, if you have an Albertsons, which in the past would be considered a credit type anchor tenant, which might trade at let's say a 5.5 cap, for example, the spread. So in other words, the additional return that you'd have to be compensated for an ethnic-based grocer. That spread has decreased now. So in other words, and that's the way that's what we're seeing in the institutional market.
And Joel.
I can dovetail right into that. What he's saying is right. That if an Albertsons is a 5.5 cap, maybe historically an ethnic grocer or something would have been a 7 cap or 150 basis points wide of that. So the price that you're paying for that asset is lower. But the reason that that's changed, at least from our view of the world, is a lot of it's driven by something we emphasize all the time in our underwriting is cash flow coverage and EBITDA to rent. In other words, what's the cash flow that the store throws off relative to the rent that we're collecting on it? And even if it's a non-credit grocer, it's a mom and pop, if we're looking at a deal that has 3 to 4 times cash flow coverage, then we are not concerned with the credit. And a lot of the institutional landscape looks at it this way too, and with the mindset of even if this grocer doesn't work out, they get over-levered, they get bought by private equity, their credit profile changes completely. I am very confident I will be able to recapture this income stream because of the cash flow and the profitability of this location as a grocer, as a restaurant, as anything, but we see the same thing.
And Michael, these changes.
It's interesting because I think some of these luxury spaces, if a tenant does fail, we have an asset on South Robertson Boulevard in LA, and the tenant moved out of there, and it's been very difficult to replace because the space changed that whole market. Rodeo Drive became popular again and easier for many retailers to find a presence. So all of a sudden, Robertson Boulevard is less important to them. And it's a difficult strategy, so you have to give very careful consideration to the credit quality, especially of a luxury tenant. And because you're betting on a long-term hold, because a person that buys your property from you is going to have a greater challenge than, say, THOR with an expertise in global leasing to replace that tenant at a fair rent.
And that's a key piece that you bring up on the leasing, that at the end of the day, this whole industry is built on a lease. We've got nothing unless we've got a lease. Everybody in here gets impacted by them. You structure them, you finance them, you build them. It's incredibly simple. Not always easy to do. So with that, are we seeing any changes in the leasing markets on the tenants that are expanding or you're doing leases on, or any meaningful changes in leases, maybe not from a technical term, but just from a business standpoint?
I mean, what we're seeing, if we want to attract, because merchandising is really critical if you're at a property like we have at 680 Madison Avenue, you want to have a complement of luxury retailers. You don't want to get desperate to just fill a void and collect some rent and then think you're going to move on, because it will degrade the perception of value for that property. So what do you have to do to persuade people to come? It's going to be a different landscape of tenancy incentives, so concessions that you're going to have to make. It may be tenant improvement allowances. It may be more advanced money that could be used partially for purposes of building out their own store, or possibly even for positioning their inventory, which is something we used to see back in 2008, 2010. And that's a dangerous place. So again, it all comes down to the credit quality of the tenant, and it all washes out, because then your rents will support. You have to keep those rents high, or it's going to impair the whole property.
I think that's a good point. If I can chime in, one of the things that we do is development. And so it ties in with the capital piece, is that you get a new tenant, and that new tenant for a new development project is going to pay, if the market rent's here, they're probably going to pay a little bit above it. And that's just the way it is, and that's fine. And banks are financing that. Well, there's some things happening regulatory-wise that are changing that, and there's things happening business-wise or in the general economy where banks are starting to change that. So to these retailers that say, great, I'll do this rent, but you've got to finance me a certain way, that marketplace is changing a little bit, because the lenders may or may not be coming with you on that. And Jonathan, does that impact your guys' business at all?
Not as much. And the reason why is, so in addition to grocery anchored and community centers, what I was thinking about when you were thinking about tenant negotiating power is, the other thing that we look at is we reposition well-located malls. And what's happening in the well-located mall space when you talk about tenants and anchor rents is that you have a lot of these anchor deals. For example, the Macy's and JCPenney's and Sears, these deals were signed 50 to 75 years ago. And so what you have is you have an opportunity where you have these tenants who are paying extremely below market rates. I mean, often 1/20th of where market rates would be if you were to cut up and reposition that box. And so there's really an opportunity then to go into that center. And a good example that most of you may know is our project, the Village at San Antonio Center, which used to be a Sears where I bought my dorm room fridge, and now it's a mixed-use project just down in Mountain View, where you have an obsolete anchor tenant paying extreme below market rent, and then there's an opportunity to go in and to purchase if they own or to buy out their lease, and then completely reposition the center, right, which then drives negotiating power, bringing other tenants into the property.
Okay. On just circling back to that one question on some of the dominant changes for you guys, is there any one of the list, capital or global economy or urbanization, or another one we didn't even talk about? But is there anything, if you just kind of think about that?
I mean, if you look at, I think the global economy and look at the consequence of currencies and why currencies are behaving the way they are, I think that it's very interesting. Mexico, we're a pretty large developer now. We have 10 different projects coast to coast underway in Mexico. And some of the retailers were pausing, because this is all ground up, so you have to lease these spaces from 0 to 100% occupancy quickly. Some of these tenants are pausing. They're concerned about the wall. They're concerned about what happens to the consumer there if the money is cut off by Wells Fargo. They're concerned about all these different things. But these are markets that are very informal for retail. They need retail desperately. They were buying retail from the person on the street that walked up to your car, or the little cart that was implemented that afternoon. So there's formal retail, and it's growing in presence there, but a lot of the markets, especially those markets we're targeting, don't have formal retail, or they don't have that lifestyle element of formal retail, which is in high appeal there. So the peso is a variable, because now people from other economies are going and taking advantage of the weakness in the peso, and it's actually driving the demand for luxury retail goods in Mexico. So you don't have to you don't want to go to Paris probably. You want to go to other markets, and it's legitimate, not counterfeit, and just at a better exchange price for you. So
You got to love how developers build the markets.
So peso denomination, and then you have to start to figure out how you're going to approach your rents. So the retailer is going to be sensitive to, am I going to be volatile with my rents being expressed in dollars or pesos? So then that's another example of a concession you may need to make.
Gotcha. And Joel, for necessity-based retail, are any of those major trends impacting you guys? You're such a large company, necessity-based, but...
So we invest only in the domestic United States, but we're certainly mindful of all these concepts up here. As it relates to globalization, I'd say mostly our focus there is what we've seen in the industrial world, which I kind of touched on earlier, but the amount of money abroad that's kind of pouring in, the cap rate compression in core product as a result of that. Because I could tell you there's two conflicting things going on right now. One is that cap rates for core product are as aggressive as ever, and a lot of that is driven by the amount of money abroad that's coming into the United States, pursuing like assets like an Amazon fulfillment center in a core market. For B and C spaces, or not as sought after, let's say main retail brands, cap rates are probably 20, 30, 40 basis points higher. In other words, prices are lower. But we look at globalization in terms of what's that doing to as a result of cap rates being compressed, our spreads are not as wide as they would be, and are we being compensated appropriately for the risk? And same with debt. We don't do any asset level debt. You know, we use our line of credit to fund all of our acquisitions, and we go out and match fund our acquisitions by either issuing bonds or equity via the public markets. But we're mindful of what's happening in the debt markets, because that does impact pricing and what the competitive landscape looks like and what other buyers are willing to pay for product. And then lastly, demographics are very important to us and what we buy and how we buy. And I'm sure everyone here is aware of this, but if you just look at the United States as a whole, all of the demographic growth in this country looks like a U. It comes down the coastlines and down into the sun belts, into Texas and Arizona, Utah, down into the southeast, down into Florida. But that is where all the growth is happening. And there certainly is an exodus right now in the Midwest, in Wisconsin, Minnesota, Ohio. A lot of those markets have retirees and people moving out. So as it relates to retail, we're certainly mindful of that, because again, being buyers of income streams, we're trying to constantly gauge what does the future of any given asset or market look like, and our ability to recapture and collect and ideally increase that income stream over time.
I think that's great lead-in about the migration that's happening to what's known as the smile states. To say if retail is going to be transformed to be more of an experience versus goods, and it's potentially going to be combining housing and retail together for mixed-use projects, where do you see opportunity today? Jonathan?
Yeah, I think this
If you buy into the concept.
Right. No, exactly. Well, I think that I think there are a couple of things. I think that when you look at, I see growth in terms of opportunities for being able to do repositionings where you have complementary uses of multifamily along with retail. I mean, the San Antonio Center is a perfect example of that. Yeah. And then when you look at also repositionings, you know, the desire for the consumers have for, you know, restaurants or gyms, fitness, or movie center experiences, right? I mean, these are the sort of experiences that draw people into your centers. So that's one of the areas that we see opportunity.
Sure. And I think there might be a slide in your book, in fact, on experiential retail. It might be one to look at. There's a lot of key drivers to that, and it's one of the areas we're talking about right now. And it's rich with things that are changing, headline news, and what's going to happen with it. We're not exactly sure, but we know things are changing, and Joel's business seems to be pretty well positioned for it. At the same time, I think THOR Equities business is pretty well positioned for it as well. How do you guys take advantage of the concept of retail being an experience versus goods, even though you're selling luxury goods, and maybe the combination of mixed-use projects that you guys are known for?
I think for us, urbanization, live, work, play, it brings people into the cities. We end up owning residential retail condominiums as often as we can. We try not to do the whole gamut. Periodically, or in the case of Guadalajara, we are building a residential tower above a retail base in Kirby, which is Houston, Texas. We're building an office and a residential apartment above a retail base. And the amenities there are going to appeal specifically to the people that we're trying to draw as tenants. It's a luxury apartment building, and so there's going to be all kinds of food offerings, nightlife offerings, all the kinds of amenities that make for an exciting experience and a reason that you'll want to live and work and play in that general area. So it definitely is important, and urbanization is going to dictate it because you got to go vertical. You're not going to go sprawl.
Joel, do you guys buy, I know your business pretty well, but do you guys buy next to St. Michael's properties? Not directly next to, but urban stuff. You guys aren't right in the urban core like they are, correct?
Not really. I mean, as much as we are a real estate shop, we are also more of a corporate finance shop. So we do, I'm trying to think, our average transaction size is probably, candidly, it's all over the boards, but if there had to be an average, it's probably like $50 or $60 million. And our transactions are typically driven by a corporate tenant's need and doing larger portfolio deals. And that takes us into main urban areas, and depending on the retailer, the business, sometimes it can take us into the outskirts as well, or more rural areas. And there's different ways to underwrite and look at each of those properties, but we're not necessarily focused on buying somewhere specifically in San Diego. And even listening to him talk about grocery, we look at grocery all over the place. And even when we sit here and we think and we talk about e-commerce, it is changing our world and our business. But how much it's going to change the future, it remains to be seen. I mean, Walmart Supercenter 10 years ago, everyone was saying Walmart's getting into grocery. All the grocers are totally screwed. It's game over for the grocers. And that has not happened at all. Instead, what we've seen, at least across the U.S., is we've seen an evolution in grocery, no doubt. I mean, we've seen the merger of Safeway and Albertsons. We've seen Kroger accumulate a lot more brands, but we've seen grocery sort of evolve and carve out its own niche. But I say all of that to just say we are more as much of a corporate finance shop as we are a real estate shop.
Just on your last point about grocery, I think it's another interesting opportunity because you think about how the grocery market's become segmented. So you use the example of Walmart getting into the grocery market.
Right.
Target has, Costco does, and you think about the typical family, and they don't necessarily go to just one grocery store to shop. They may go to Whole Foods for some items, but go to Target Express or Walmart or another type. So I see that as being more fragmentation creates more opportunity.
Yeah, more opportunity, and absolutely. Trader Joe's, Whole Foods, Sprouts. I mean, and depending on where you live, they're all of these newer little boutique-y concepts are popping up with more deli offerings, wine, catering services. Just they're kind of creating and carving out these niches, and that creates opportunity. Where 10 years ago, a lot of us just heard noise all the time of it's Walmart. They're going to own the grocery world, and that has not happened, and I personally don't believe that ever will happen. Does it impact and change the landscape? Sure. But does it mean that grocery as we have known it is over? No way.
Well, I'm with you on that. When I found out Walmart was targeting closing 150 plus stores, that made me stop and take pause. What is going on? And then I talked with a bunch of leasing brokers across the country, and the amount of emerging concepts, as they're called, that are coming to the marketplace is significant. How are they getting financed? Well, they might come over to Joel, but how are they getting financed? And are those necessity-based, luxury-based? Luxury has a whole different connotation. Tying in with this, we were talking about store closures, and there was 4,000 of them in 2016, 26 major bankruptcies. We can all probably guess why that was occurring. But with that is the secondary mall that was all the rage for 20, 30 years. Is the secondary mall dead? Does it need to get repurposed? Jonathan, do you guys have any friends in that space or any perspective?
We won't look at secondary malls. My feeling is that maybe they become sort of distribution centers, a CarMax, warehouse space. I think it's an open question. I don't know what happens.
I think some of those secondary malls are just too big. to be repurposed efficiently, and they're going to have to be raised and new opportunities for that land. You know, a lot of those malls, it's like a whole tidal wave effect, basically, that one Sears announcement, and all of a sudden, all the other leases that have a rent that's stipulated by the rent being paid, that Sears is present, and the moment they go dark, then they can revisit their rent, and all of a sudden the mall's dark. And then there's no reason for it, because there's a nice, beautiful Simon Mall or a Tomlinson Center, you know, very close by, and why go to the one that's fledgling with half-baked tenancy? Just go to the nice mall, and they just permanently die. And they're too big to really repurpose in a lot of times.
Yeah, that's a good point. I'll represent the malls just for a minute, even though I'm not with a mall. Over the last 5 years, malls have capitalized themselves very well. Let's talk about public firms that own malls, because that's who owns most of them. They've capitalized themselves very well, and they've sold off their non-core assets, helping make their balance sheet and income statements even stronger. And they put a lot of effort into omni-channel marketing as well to try and get ahead of this wave of what we're seeing right now. So they've really distanced, a national or a regional mall has really distanced itself from a product offering for a retailer to a secondary mall. And in the last 5 years, is what we've seen a lot of change in. But doesn't mean there's not opportunity. An old style grocery store was built with a large format grocery store, and on either side of it, maybe in your community, you'll see a lot of shop spaces, it's called smaller retailers. That model's not quite as prevalent anymore for economic reasons. Think about who the retailers are on those small spaces. It makes it kind of tough. And if somebody takes one of those back, and they are trading in the marketplace, if somebody takes one back, what do they do with it? I think Jonathan's group, because I happen to know them a little bit, very creative minds, and what do you do with that? I don't know about on the luxury side, but does something like that?
No, there's no path for the luxury there.
I wouldn't imagine. I wouldn't imagine.
THOR used to have a very significant presence in that space, and you know, one by one, those B and C malls just disappear, and they go away for good.
Makes sense. Tough. If THOR bought a property in Silicon Valley, do you think that THOR would continue to buy in the area, and if so, any submarkets that pop up?
Yeah, we love this market. San Jose and Oakland and you know, Soma are all targeted for us, and you'll be reading about additional closings in the coming weeks. They're not our typical luxury retail. As I mentioned, we've been moving into more of a maybe solving for tech demand, or maybe solving for long-term holds in a really ripe market. The whole transportation panel this morning I found really enticing, because we're buying in anticipation of the extension of the lines or the consequences of the development in the area of new stations.
Is financing changing at all for those kind of assets? That got brought up on the TOD panel, that how are they getting financed? But when you get involved with these longer-term suburban planning being brought into it, is financing becoming more unusual?
They tend to be syndicated equity deals, not institutional equity, for the greater level of patience that's going to possibly be required, but the financing's traditional. It might just be a different LTV, but it's traditional.
All right. Now, you've got all this information. We've talked about property cycles are kind of near their peak, if you will. And we've got all these changes up on the board, which we haven't unpacked them in detail because we don't have 15 hours. But they're there, and they are influencing all of these gentlemen's business and the industry overall. So if we kind of start to talk now about, from a portfolio standpoint, what are some offensive strategies that one might take, looking at these changes are real and that they're going to be impactful, try to just hold on to their capital and not invest right now and waiting to see how things shake out? Or over the next couple of years, would they pursue maybe a lease to core or develop a core strategy versus just buying existing space and doing a renovation? Or any other offensive kind of strategies that you could think of? What do you think, Michael?
I think with an orientation to a reasonable hold period of in excess of 5 years, the cycles will work themselves out. You're going to have possibly some softness, and you'll see a dip in asking rents. And as long as you did a good job with underwriting of your tenancy, and you preserve your tenancy and your rents, that you're going to be in a position as that market rises to demonstrate to a new buyer, one, the below market rate and the rent, and that you have an opportunity existing in this asset as you consider its purchase. You're going to underwrite for that with a compressed cap rate, and we're going to get the market cycle going again. I think that's what's going to happen. If you think you're going to buy and flip or buy quickly, lease and sell, you might, in 2 years' time, you might not like where you are in the cycle. You might see an increase in the cap rates. It'll hurt you.
Okay, and even tying in with, sorry to stay here at Michael for a minute, but infrastructure projects that got talked about earlier today, is that a strategy where high-end luxury is trying to locate near those new infrastructure projects?
Only to the extent of these, the expansion of the BART lines or whatever, where these markets, because of the tech and the burden of employees of these tech companies, where they're going to live and afford to live, and give them the amenities in the areas where they are able to live or want to live. And we're watching all the major companies all moving to satellite offices to accommodate them into these other markets. And one of the buildings we just bought is right next to the new Apple location. So those are examples of what we're looking at is the natural shift of these growing companies and where they're going to accommodate their employees. They're going to go out of their way to accommodate their employees because there's a lot of competition for those employees.
That's a good
And
point.
so get ahead of that.
Jonathan, any defensive strategies you guys are approaching?
The way I think, we tend to be less focused on economic cycles, and our funds are they're 15-year funds, so it's a very long-term horizon. And I think that really what we come back to really focusing on offensively is really underwriting, the asset itself. Especially in retail, where you think about how important it is, which corner you're on, right? Versus an office building, which is more a commodity product, and I know there are a lot of attorneys in the audience, and law firms, for example, will often, move from one office building to the next just to save pennies in rent. And, it's different in retail. So what we will always come back to, really focusing on underwriting, more the individual asset level with less of a focus on where we are in economic trends.
Okay. And Joel, you guys have so much going on across the country, and you got necessity-based, you stick to your investment strategy. Are there different offensive strategies that help navigate those waters?
Well, similar to what Jonathan just said, it's the old rule in real estate, which everyone knows, but location, location, location. That's one that, regardless of product type, is really fundamentally important. We do stay away. Suburban office, it's funny because I was looking at that slide about me, and I should have told you to take office out, because we really are not buyers of suburban office, or any office for that matter, just because of how constantly that world is evolving and changing, and needs in office space evolve, and for workforces evolve. So that's not something we buy. But to your point, we really look at what is the location, the demand drivers for this piece of real estate, whether it's a piece of retail real estate or industrial real estate. What do we believe the long-term demand is for that site? And ultimately, we're buyers of income streams. So we want to be buying rents that we are very confident we will be able to replicate and increase over time. And we were talking about malls and big box retail. I would tell everyone, I believe that big box retail is under a tremendous amount of pressure right now. And I know we were talking earlier in San Diego County, which is the United States as a whole, Southern California, and even up here in Northern California for that matter, is cap rates property trades very aggressively. But in San Diego County, 1.1 million square feet went vacant in 2016. And of that, only 350,000 square feet was absorbed of big box retail real estate. And I mention that just to say that, man, the landscape there is changing a lot. And again, if you don't have the right location, those income streams are at risk. And we're seeing it in San Diego today. So that's how we maintain our discipline, is just looking at what's the income stream we're buying and how confident are we're going to be able to replicate that in the event we get this asset back.
That makes sense. And I'd even argue that the investment strategy your firm approaches with necessity-based retail, that one, you're more insulated from a number of these changes than others. For example, if you look in the secular trends, you got the demographics, urbanization, technology, and energy. Well, with necessity-based, you're going to be able to make those migrations with those shifts. Mm-hmm. With the large structural shifts that are occurring, I think your company, the tenants that your company invests in, are going to fare pretty well also. Yeah. I think it's this middle space. You've got necessity-based and you've got luxury. I think it's the middle space of demographics and the middle class and the retailers that try to sell to them, I don't know if Sears is a great example of that, but it very well might be, that they're not doing as great as they could or wish they would, and because it's in that middle space. And this is really starting to create a divide on that.
I mean, the way we look at assets, again, is just that we're not doing arbitrage plays. We're not looking to flip or create value short term. It's just, again, to pay a dividend and to increase the dividend over time. For us to sell assets just creates a problem. It just puts money back in our pocket that now we have to go out and redeploy and recapture that same equivalent or better income stream elsewhere. So
those were offensive strategies. Any defensive strategies in looking at your portfolio and what you might want to do?
You know, I think that what I think about, especially when repositioning properties, is always underwriting a base case scenario that'll work without assuming that you're going to be obtaining any sort of discretionary, approvals from because, for example, with a big box space, right, a lot of those well-located properties are very well situated to be converted into additional uses, and which usually requires some sort of entitlement process. But from a defensive side, right, we would never assume that has to happen in order for the deal to work. So what's your downside? What can you end up with, consistent with current zoning? How can you reposition that way?
For the business, is there any difference in how you're structuring leases? As for a defensive strategy, structuring key leases longer term now and giving up some concessions to do so, or are you changing around the capital program at the fund level or at the asset level?
I think that we'll always look to, for tenants that we'd like to keep, look at blend and extend, right? So in other words, being willing to invest into the center or invest into their property and extending their term, right? And maybe they pay a blended and extended rent. So that would be an example of a defensive strategy we use.
Okay. Michael, what about in the luxury space? Do people just lock in long-term leases all the time, or are they doing shorter-term leases now?
New concepts always want shorter because they're themselves uncertain about the success, but any more successful brand wants, 2 5-year, 2 10-year renewal terms on top of 15 base.
Do you think it's critical that people are extending, making sure that when they're writing leases or renewing leases, that they're making sure that they're past 2020? We have a administration in right now that we don't know exactly what's going to happen.
I don't think in that segment you would want to, because the experience, like on Fifth Avenue, where we watch rents climb from $1,500 to $3,200 a foot in about 18 months, you'd miss the window if you stuck too long. You have to have some vulnerability and then be ready for the next cycle.
That's such a very good point, capturing that upside. And I think we talked about the disparity of the various sub-property types in pricing and also the economics and that are influenced or insulated from e-commerce and the other. And I think that that's a key consideration in the property type you're playing with. Do you think there's rent growth, and how do you capture it? Because that's how you make return and protect your risk. With that, we've done a great job here, and we'd love to play with you guys. So, any questions?
Okay, I'm wondering if the closure of all those chain retail, big box type stores is only caused by e-commerce, or is there a slowdown in consumer discretionary spending?
I mean, I would comment that there's a third reason, and it's just that the mall became irrelevant, and therefore the store's demand became less, and it's because there are other higher quality malls within regional, few miles sometimes, where you can go to this beautiful lifestyle mall, or you go to this dark, boring, and by, just progressively it's a fail for some of those stores. And I would say that that's it more than it's e-commerce. I haven't seen any real evidence of e-commerce in goods that people want to touch, try on. A lot of malls are oriented toward fabric, garment. They want to see how it fits them. They don't want to send it back. That's a hassle. So I think it's more a function of the malls just aren't appealing anymore. The ones that you've seen fail, and therefore the big box is the first to feel it.
I think another reason is a lot of times that these mid-market retailers may be under pressure to show growth. So what they've done is they've introduced discount concepts to the market. For example, Saks on Fifth or Nordstrom Rack, and I think you're starting to see sale cannibalization.
The two best performing sectors in retail right now are discounters in food uses. Food uses of various price ranges, but they continue to keep going and going and going and expanding and higher revenues. One of the things we saw in 2016 was the first time we saw is that restaurant sales was higher than grocery sales. Never before had we seen that. So if we ask why, well, there's 70 million boomers, 80 million millennials. We keep hearing about millennials, but together, that's 150 million people. That's a lot of buying power. That's a phrase we use in retail. It's a lot of buying power. But there's also a lot of wage discrepancy. It's kind of like this panel. We've got necessity and luxury, and it's happening in America with the wages. Middle-class jobs are going away, and let's not go into that. Ken would probably be the best one to talk about that anyways. But middle-class jobs are going away, middle-class wages are going away, and things are going to the ends of the continuum. So it's changing the landscape of retail. Their businesses have to be set up really well for this, and it's kind of nice that we get to see from their perspective. But yeah, Joel.
No, I was just going to say, I mean, to your point, a lot of these retailers also weren't set up for their top lines to take a hit. A lot of that is driven by e-commerce, but even a company like Kohl's, which is today, that's an investment grade credit, highly sought after deal, not necessarily a mall tenant, still a mid-box tenant. Their business has been under just a ton of pressure. Whether or not they're going to get downgraded, what happens there, I mean, remains to be seen. But that combined with the fact too that even this is something that we haven't seen happen yet, but I can assure everyone I think you will see. The drugstores. Over the years, the drugstores, CVS, Walgreens, Rite Aid, they were beating each other up everywhere, to be on every corner, to grow ridiculously, to grow at all costs, to control every corner, to commit to income streams and rents that were wildly above market. And anyone in this room that owns drugstores or knows anything about that, it's only a matter of time before you probably start getting some phone calls and requests for rent reductions, because that growth comes at a cost. And that's something that we've seen that evolution in the restaurant industry. Back in 05, 06, 07, casual dining restaurants were growing. They were committing to income streams and year-over-year rent growth that was just unsustainable. And come 08, 09, a lot of people got washed out as a result of that. So not all companies are as mindful of or set up for their top lines to really take a hit, and then the impact that has. And even a lot of the big box retailers we've mentioned, it's some similar themes across all of them and some slight differences too, just with leverage and what happens when cash flow down, interest, your debt costs go up. A lot of companies cannot afford that or don't have that margin for error.
If we're talking about the SMILE in necessity-based investing or projects, isn't it really a pricing and merchandising question? I mean, why isn't the inner part of that SMILE, why isn't that equally as desirable so long as the real estate is priced right? Because by definition, necessity-based, if there's people living there, they're buying.
And for us, no, that is true. Everything is a function of just, is there demand? And just because there's population growth, like let's say, for example, Cincinnati, Ohio is maybe, and honestly, I'm just making these numbers up. I don't really know what the numbers are, but just assume that the population there is declining by 5% and it's growing in Houston by 10%. Well, does that mean that we shouldn't invest at all in Cincinnati? No, absolutely not. That's not what I'm saying at all. But I think it's worthwhile to be mindful of. It's just like Phoenix, Arizona. Great example of a market that in the boom times just exploded. Housing prices out on the west side of Phoenix and places you've never heard of were like $600,000, $700,000. 2008 and 9 comes along, you couldn't pay someone $100,000 to take these houses. And so when we look at demographics and shifts, we're mindful of that, but that doesn't necessarily, it's not a black and white answer of, wow, this market's declining, so no matter what, there's no need for this market anymore. Like Detroit, an obvious market that's really struggled. Well, is Detroit going to just disappear, and are we never going to see the Lions again? Probably. We'll probably still see them for some time to come, but it's just being mindful of those trends and where in these markets are you buying. And like Phoenix, again, I wouldn't buy out on the wild outskirts at real high rents. If I'm going to buy, I'm going to be mindful of the income stream and where does it fit into that market. If that makes sense.
Okay, I think we've got time for 2 more questions.
To the point of the shopping center being having a sense of place, I find that for my own self and for a lot of people that I see in shopping malls, they're there for recreational shopping. They're there to be part of a social scene and to be entertained. And do you see that as the future of malls? Because that's something you don't get online. Besides not being able to feel the material, you don't get that sense of socialization of something happening and the entertainment value.
I would say absolutely, and it's best demonstrated by the brand-new malls we're developing in Mexico, and they all have that element to them. It all is a draw that people come for hours. They'll sit there and they'll walk around. They'll make an experience out of the visit to the mall, and they will shop. But they also are there for the evening. It's an exit for their family from the routine. And I think that's going to be the influence. And the most successful malls you see in America all have that element to them.
Okay, last question. It's been a great day. Unless anybody else wanted to comment, sorry, panelists. No?
Do you sense that the uncertain political climate is going to positively or negatively impact the influx of foreign capital into the U.S. real estate market?
Go ahead. Go ahead.
All of us chime in on that one. I'll give you my quick 2 cents. I have no idea, but we're not seeing, that's the honest answer, but we're not seeing any pullback as a result today. In other words, the money that we've seen from abroad, for a lot from Asia, from Germany, from the Middle East, it has been coming in aggressively into this country, and notably in the industrial world, which is a new world for a lot of this money. For the past year and a half, and even after the Trump winning the election in November, we've seen no pullback at all. So that's what that means going forward. I don't know.
I mean, I go to Europe a lot for real estate events, and over there the German interest is relatively new again in America because they pretty much stayed clear. Now they see it as weaker and opportunistic for long-term because they have the same thing. They have these open-ended REITs that they have to support with dividend yield, but they're principally pension funds. So the Germans love it. The Asians were largely coming with their money to park it safely, and there's been some blocks on their ability to get the money out and or to put it safely. But we saw it in London, we saw it in New York with a bunch of vacant apartments, that someone paid $100 million for and they never even lived there. So there's been various reasons why that Asian money has sort of slowed down, but it's still coming. And I think, other markets like Brazil was a really important one in Miami. Again, it was the proximity for them. They were buying a lot of wonderful real estate. And it's the absence of that money that's definitely changed the face of the value of the real estate because there's not as much chasing the deals now. But I still see money coming because everyone views America as being a safe place ultimately for investment. Your assets will not be seized by the U.S. government one day.
Jonathan?
No, I agree with that. I think I've done fundraising in China before, and I think that it's just the desire to flee to safety, right? And it's the idea. I think there's also an exchange rate calculation too that's going on there also. So it's not necessarily returns that the money is chasing. It's safety and other considerations.
Well, thank you very much. Thank you.